In this video, I'm going to talk about debt and how WiserRobo can help you get a handle on what your debt is costing you and helping you plan on eliminating it based on your budget in a way that's manageable and realistic. And I'm going to do this through a new WiserRobo question and answer, namely this one: what's the impact of my debt on my financial picture? And if we select that, we're given the opportunity to set up a debt tracking calculator. And the first step is to capture some details that can help build an accurate picture about your finances. And we've got the ability here to select a budget if we've created one previously using WiserRobo. And we've talked about budgets in other videos and articles, and it's an important base from which we can offer advice based on algorithms. And in that spirit, I'm going to select a budget that I previously set up based on the sample bank account that we offer with WiserRobo. Next, I'm able to pick an investment balancer plan if I've got one set up. And this is optional, but it's part of creating a complete picture about your finances. We'll see how it gets used shortly. And next, we can indicate how important liquidity is for us. And liquidity in this setting has to do with paying down debt that we can draw on easily in the future if we need to. For example, paying down a mortgage has advantages if your interest rate is high on it, but you usually can't go back and pull out funds in an emergency without going down a different road, like a home line of credit, for example. Normally, we'd favor paying down your most expensive debt first, so this liquidity setting is only an influence, not an absolute. And next, we're able to enter our average tax rate, and this is useful since a common concept of debt to income relies on gross income, and what we're potentially capturing from your bank accounts might reflect net income. And clicking next, we're asked for our monthly housing costs and monthly costs that include things like, say, child support, alimony, court order payments, and so on. And these are important when trying to determine your back-end debt to income ratio. And the values here can be defaulted from what we found in your budget if you linked to one in the prior step. And that's just one example of how we can make it easier for you. You don't need to try and do those calculations yourself, but you can verify them here. And finally, we can itemize our debt. For example, I'm going to add a new credit card account by clicking here on Add. And in this pop-up, I'm going to start providing some details about this debt item. I'll give it a name of card, and I'm going to set the type to credit card. And if I know the current balance, I can enter it here. And there's an option to enter the opening balance, which is useful for loans where you get an initial cash payment, for example. But as a credit card here, chances are the easiest way to go is with the current balance. And the disadvantage is we won't be able to tell you much about your past interest paid, for example. And I'll enter the annual interest rate here. And I'll go with 14.5%, which is very ouch, but hey, it's a credit card. And here we can indicate out of which budget bucket we're making payments. And for a credit card, chances are good it's not going to be recurring, since amounts may vary depending on our varying credit card balance. And now we can enter the payment frequency. And notice we've got a number of options, but let's go with monthly for this one. And I'll enter a current payment amount of $250. And it's not a fixed amount. I could pay down more than $250 if I wanted, and if there's a minimum payment, I could enter that here. And keep in mind, this answer is still under development, so expect more settings, probably a lot more actually. And I'm going to finish this one up and click Save. And from here I can save all the work I've done, and then next time I visit the answer, I don't have to re-enter all of this. And I can also click Calculate, like I'm doing here, and we'll get some commentary based on the information we've entered. And the first thing we see is the item we just added, this credit card with a balance of $15,000. And we can see over here that we'd have it paid off in about 9 years if we maintained our current payment level. The next section includes a chart showing what those 9 years would look like. And we've got a steady payment of $250 a month over those 9 years, with an increasing proportion going to pay down principal. In the next section, we've got a discussion about our debt to income ratio. And debt to income is a useful metric since a lot of creditors use this to judge your creditworthiness. And it can also tell us about how stressed you are in general with respect to debt and obligations that resemble debt, things like alimony or child support payments and so on. And this back-end ratio is really all of your housing costs and obligations and debts, like this credit card that we just added. And at 34%, it's getting a bit high. And here we're using the power of your budget to identify some possible opportunities to cut expenses, using what's saved from that to pay down your debt. And this next section details what we're specifically suggesting. So for example, we identified some possible cuts in restaurants and shopping and entertainment totaling just over $100 per month. And is something like that realistic for you? Well, that's up to you, but if it is, we show here what using those funds to pay down debt would actually look like. And notice it changes your ability to pay off this debt significantly faster, 4 whole years faster in fact. And with this button, we can actually update our budget to reflect the suggestions and can track how we're doing with the lower limits on a monthly basis. And here we've got a graphical view of how the payoff would go through these somewhat higher monthly payments. So let's look at a tweak to this plan. I'll click Edit and Return to set up another type of debt. And let's set this one up as a home line of credit, where we know the balance started out as $50,000 roughly 2 years ago, say. And we'll set a lower interest rate, say 6.5%. And let's set the payments frequency to say bi-weekly. And let's say we're making bi-weekly payments of $220, but let's say the minimum amount is known to be $170 bi-weekly. And let's run the calculation again now. And we can see that there's 2 items listed in the summary now. And the summary shows us we've got suggestions pending that could lower the amount of total interest we pay combined over both types of debt. In fact, you can see how we're actually paying more interest on our home line of credit, but we're paying far less on the credit card. And if we scroll down, we can see a payoff schedule provided where the suggestion is to pay the $170 minimum bi-weekly on the home line of credit, but pay pretty much every other penny we've allocated for debt to the credit card. And the credit card amount is varying per month, so in some months we might need to make 3 line of credit payments and some have 2 payments. And the algorithm here is trying to keep us paying about $837 per month towards all types of debt. And eventually we reach a point where the credit card is paid off and the suggestion is made to change the line of credit payments to be $279 instead of $170. And why $279? Well, 279 times 3 is 837, which is the amount that we're trying to allocate to debt payments per month in general. And in some months we'll only make 2 payments, but the default setting of keep payments fixed means we'd err on the side of not overburdening you at the expense of not paying down this line of credit technically as fast as we could if we use the full $837 per month. And we can control this behavior by going back and editing the line of credit settings. And so here I'll change the monthly payment setting to keep monthly outlay fixed. And I'll try calculating this again. And now we've got to vary how much we pay bi-weekly for the credit line as seen in the revised paydown chart. But our monthly outlay for debt is fixed and we end up paying everything off more quickly as shown here. In 3 years less time than if not using our suggestions. And this next section deals with investments, in particular how you might take advantage of the money you're saving by paying off your debts quickly. And if our linked investment account has enough history and has done well enough, we'll be seeing a simulated forward projection of our investment account performance where we're investing the payments we'd have normally been using to finish paying off our debt. But since we finished paying it off early by increasing our monthly payment, the amount invested is shown here and has actually grown significantly. And we show it here starting from the point of all the interest you'll have paid as a deficit. But in reality, your brokerage account balance that was making a 5% annualized return on what would have been your debt payments would actually be more like $30,000. And that's a pretty cool, if not stunning, factor in helping illustrate the value in increasing your debt paydown rate and in continuing to carve out that part of your budget for investing, since you've already been living without that part of your income, so to speak. And it also illustrates the creative things that we can do with your data, not just with this answer, but really any answer. And if you can think of a way to improve any answer, there's a simple way to do that. Just click here on More. And you can offer comments that are actionable by us to enhance and improve every single question and answer. And finally, since we didn't indicate these debt payments are either in our budget's recurring category or aren't already in a virtual account, we could simply click this button and our budget would be updated to reflect this as a new debt virtual account. And this has the advantage of traceability and visibility, so it's worth exploring the concept of virtual accounts more. So what are the key takeaways here? First, I hope this illustrates the benefits of having a consolidated view of your finances. We can look across budgets and investments and transactions to both advise and track. Second, it shows how we can provide actionable insights. For example, suggestions for cutting back expenses to let you increase your debt payments, driven by a combination of crowdsourced data and intelligent algorithms. And third, our goal is to offer more than traditional tools that might look similar. For example, there's plenty of debt calculators out there, but we expose many more dials, so to speak, letting you tweak answers to your unique circumstances and preferences. And that's a common principle throughout WiserRobo. We're able to help you succeed by offering new ways to look at and think about your finances in really an unbounded way. And as usual, there's a lot going on with this example, so watch for another blog article that gets into more depth on this and other answers, of course. And this particular answer is a very relevant fourth pillar of WiserRobo's functionality, which includes budgeting, investing, financial freedom, and debt management. So I hope you enjoyed, and take care.